Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and as always, I am going to be the host for this podcast today, and I'm coming to you live from Madrid, Spain, so I'm excited to be here. This is episode 164, and the title for this episode is an overview of Biden's proposed tax legislation. So I want to go through some of the big items. Now, there are thousands and thousands of pages. I think it's just north of 2,000 pages in the tax legislation, and the vast majority, if not all of the Senate and the Congress and the House have not had the opportunity to read it. But the House just voted on it and approved it, so now it's going to go to the next level, and we'll see what happens then. But this is going to be huge because at the end of the day, you know, the increase in taxes is going to create some major challenges for the vast majority of Americans looking to maximize their investment, their retirement in not only 2021, but 2021 and beyond. So, like they always say, timing is everything in life. And I've been doing this now for a long time, so I do have quite a bit of experience regarding the different tax legislation that we have had over the last 35 years. And what I can tell you is that timing is everything. And the reason why timing is everything is that there are times where, it may be feasible to go ahead and increase taxes depending on what it is that you're going to do and the targeted approach as to what you want to do. But most of the time it may not be suitable, and definitely not in 2021, especially when we're dealing with some of the major issues that I'm going to be talking about in the next few minutes. So, once again, timing is everything, and I don't think this is the right timing to create some tax increases for the American people. Now, let's take a look at inflation. Inflation is at over 5%. Now, that's overall inflation rate, but it really doesn't, when you factor in the essential products and services that Americans are purchasing every day, inflation is much, much higher than 5%. Unemployment is at over 5% as well, so although it has come down a little bit, but one of the biggest challenges that we're having with unemployment now is twofold. Number one, we have a supply chain clogged up in all the different ports throughout the United States, especially in California and the Long Beach port. So that's creating major, major issues, especially as we approach the holiday season in the United States and throughout the world. Small businesses are suffering significantly, and I'll touch upon that in the next few minutes as well. One of the worst things that I've seen in a lot of the reporting that I read on a weekly basis is that Americans are leaving the workforce. So a lot of Americans are just either leaving the workforce or they have decided not to seek employment. And that's a major problem because it's going to hurt each and every one of us. And I don't care whether you're lower class, lower middle class, upper middle class, or the wealthy. If you have a supply chain clogged up, throughout the United States and the world, then everyone is going to suffer along those lines. And now, one of the things I did tell you that small businesses are suffering, but one of the things that small businesses are doing is they're counterattacking the mandated tax increases, homeless tax increases, the $15 minimum wage, and the lack of employee availability. And I saw that vividly last month when I attended my daughter's wedding in Portland, Oregon. I went to a restaurant, and they give you an area in the menu where they tell you that they have increased the prices because of mandated tax increases, homeless tax increases, a $15 minimum wage, and the lack of employee availability. And they're adding a surcharge to the food and the drinks that you have at the restaurant in order to offset those liabilities. So what does that tell you? That tells you that, at the end of the day, when you raise taxes on small businesses, the small businesses are going to pass those taxes on to the consumer. And they're going to be raising the prices of, everything that they sell, because a lot of the inventory that they purchase on an ongoing basis is also being increased because of the supply chain issues and the inflation that is happening throughout the United States. So this is definitely not a good time to start increasing taxes. From an economic, political, and even national security, the southern border is now a nightmare. And that's a major issue for Americans, because if we don't have a secure border, then Americans are not going to feel comfortable. They're not going to feel secure, and that's going to be something that is going to be debated quite heavily in the 2022 midterm elections. So that's something that is going to become a hot potato. It's already a hot potato, but it's going to be even hotter now come 2022. Another major issue that we're going through in the United States right now is that, the Afghanistan withdrawal was a nightmare, and hundreds of Americans have been left behind. I think it's been over 90 days now, and we're still dealing with hundreds of Americans that have been left behind, to the point that, private military organizations have had to do a lot of due diligence. They have taken the leadership role in trying to get those Americans out, because the U.S. government is not doing much about it anyways. And now a potential $1.3 trillion spending package on top of another package of $1.9 trillion that had been previously approved is now moving through Congress. So the original proposal was $3.5 trillion. I think that was reduced to finally $1.3 trillion. What's interesting about that package, if you read some of the excerpts that I have been reading, is that less than 10% of the $1.3 trillion is actually going toward infrastructure, which is something that they wanted to do in this package. So how can you call it an infrastructure package when only 10% of it, barely, is going for infrastructure from that perspective? So, we seem to be losing respect for the value of $1 trillion. And, most of the clients that I deal with on an ongoing basis are always asking me, Bert, what's $1 trillion? Can we quantify mathematically what $1 trillion is? Because obviously it's a number plus 12 zeros behind it. But, let me see if I can put it to you in terms that may be easier to understand from a business and economic perspective. So let's see if we can compare what $1 trillion is in terms of days for comparison purposes. So if we do that, then $1 million was 12 days ago. So $1 million was about 12 days ago. $1 billion. George Herbert Bush was president of the United States, and that would be equal to 1 billion days ago. 1 trillion days ago, ladies and gentlemen, the Neanderthal primates were walking the earth. So that tells you the difference between 1 million, 1 billion, and 1 trillion. 1 million days was 12 days ago. $1 million was 12 days ago. $1 billion, Bush was president. Bush 1 was president of the United States, and then 1 trillion days ago, the Neanderthal primates were walking the earth. I wanted to repeat that for the sake of understanding, because when you really start thinking about what $1 trillion is, it's an enormous amount of money. Now, let alone right now in this country, we're close to $29 trillion in debt on our national debt. And when you take a look at the unfunded liabilities for Social Security, Medicare, Medicaid, Medicare Part D, and the interest on the national debt, we're approaching $160 trillion. So that tells you the amount of enormous debt that we have in this country. I feel very strongly that our national debt is more of a national security than China and the Russians, and even Iran for that matter. Our inability to be able to cope with an increasing inflation, and also with the fact that, we owe so much money that we don't even know how to pay for it, although we can continue to print. But remember, when the U.S. government is printing dollars, that basically means that that's a tax, an additional tax on your savings, because that means that every dollar that you have in savings is worth less and less and less. Now, obviously, the new tax proposal increase is supposedly geared toward infrastructure, although only 10% of it is truly infrastructure. But what has happened, and this happens with politicians all the time, is that the definition of infrastructure has been ill-expanded to include hundreds of billions of dollars in what I call pork crap. So what is this tax proposal all about? Well, in a nutshell, there are two proposals. There's one called the BBBA, which is Biden's Build Better Act. And then the other one is called the BIB, which is the Bipartisan Infrastructure Bill. And both I have a lot of issues and concerns with both of them. So let's take a look at some of the major issues without going through a lot of the other challenges and a lot of the other ill-wasted and ill-spent money that you'll find in that bill. But let's go through some of the major items. So let's talk a little bit about tax proposals affecting individuals and businesses. So how are the new tax law going to be impacting each and every one of us, each and every one of you? Well, individual tax rates, the top marginal tax rate would return back to the 39.6%, which was the number that was there prior to Donald Trump's Tax Cuts and Jobs Act, which was called the TCJA, which cut it to 37%. So it's going up to 39.6%. Now, that rate applies to married filing jointly and people that earn in excess of $450,000 as a married filing jointly filer. Now, if you're a single filer and your income is north of $400,000, or if you're married filing separately, then it'll be $225,000, which would be half of the married filing jointly of $450,000. Now, there's also a 3% surcharge for modified adjustable gross income above $5 million. So for most Americans, that part of the 3% surcharge is not going to be applicable, but for a number of Americans, many Americans, the 39.6 is going to have a negative impact. And always remember that the vast majority of the tax-paying Americans happen to find themselves in the 39.6% tax bracket. They happen to be small business owners that are working sun up to sundown. And because they're generating a lot of revenues, a lot of that revenue is going to be taxed. And what do you think is going to happen? Well, when they go from 37% to 39.6%, guess who's going to pay that additional 2.6% of taxes? Well, they're going to pass that on, like they do everything else, to the consumer. So you and I are going to end up paying no matter what along those lines. Now, for capital gains and qualified dividends, maximum rate would go from 20% to 25% for taxpayers in the 39.6% tax bracket. So, if you happen to be in the 39.6% tax bracket, and you also have capital gains in a given year, then that's going to go from 20% to 25%. Once again, what are you going to do if you happen to be in that tax bracket and you happen to be a small business owner? You're going to pass that on to the consumer. Now, for those of you that don't own a business, you don't have to worry about this, but if you own a business, if you own a small business, one of the great advantages that the Tax Cuts and Jobs Act of the Trump administration did for small businesses was that they did what is called a qualified business income, QBI, which is Section 199A deductions for pass-through entities. You can take a deduction up to 20%. But now under the new tax law, that would be limited to $500,000 for married filing jointly taxpayers and $250,000 for single filers. So if you go north of that, then that benefit starts to go away. Now, the new proposed plan also has had an impact on retirement planning. Now, the BBBA prohibits IRA contributions for taxpayers whose aggregate account values exceed $10 million. Once again, the vast majority of Americans do not have IRA accounts in the $10 million mark. The wealthy do, and people that have small businesses that may have defined benefit pension plans, and they've been in business for 20, 30 years, they may have that kind of money inside their pensions or IRAs. So that's going to have an impact on them again. So what does that mean? That means if you have small business owners that have IRA accounts of 10 million or more, and they're not able to make a contribution to an IRA and take a tax deduction, then that additional tax that they're going to be paying on their income, because they are a small business owner, they're going to be passing that on to each and every one of us. So there's also something called in the tax law the Backdoor Roth, which is primarily for those Americans that make too much money and they cannot make contributions to a Roth because of the Roth limitations. They were able to make a non-deductible contribution to an IRA, and then they would convert that non-deductible contribution to an IRA to a Roth and be able to have tax-free income on that account for the rest of their lives. Well, that's going to go away. And that's going to be prohibited for married filing jointly filers with income exceeding $450,000 and $400,000 for married filing single and single filer. So those are things that once again is going to have a negative impact on the entire society, on the business society overall. Now, there's also the child and dependent credit, which most of the clients enjoy today. My clients, when I do taxes and tax planning for them. But the American Rescue Plan, enacted in 2021, temporarily expanded both the CTC, which was the child tax credit, and the DCTC, the dependent care tax credit. And so that was extended, which I think that was a good idea. So that may be, that's one of the things that I like about the American Rescue Plan, in that they have temporarily expanded both the CTC and the DCTC along the way. Now, the BBBA would extend it through 2025, and I'm hoping that at some point in time in the future, they may make that permanent as a way to maximize the opportunities for families with small children. Now, premium tax credits, which is something that, from a taxable standpoint, a lot of my clients enjoy. The BBBA would permanently expand the credit for healthcare purchases. So if you purchase healthcare plans, especially if you happen to be involved in the Affordable Care Act, better known as Obamacare, then that would be expanded as well there. Banking activity reporting, the proposed $600 requirements received tremendous pushback from banks, Republicans, and Democrats alike. So they've done away with that. So that's a good thing, because that would increase the amount of reporting, that would increase the amount of employees that banks would have to hire. And again, it increases the cost, and they're going to be passing that cost to the American consumer anyways. So that's something that I'm glad that the new proposed tax plan is going to do away with from that perspective. So that's good from that point of view. The corporate tax rate, and this is another one that I have a concern with, would increase from the Tax Cuts and Jobs Act that President Trump put into place as of January 1 of 2018. It would increase it from 21% for corporations to the BBBA of 26.5%. And that would be a graduated increase. So as the income of the corporation would increase, so with that tax rate moving from 21% to a maximum of 26.5%. Once again, what do you think that's going to do? Well, simply speaking, if you increase the tax rates for, Home Depot or Walmart or, some of the major corporations that you deal with every single day, banking companies and so forth, what do you think they're going to be doing? They're going to be increasing the pricing for the values and the services that they provide. And the same thing applies with the gift and estate taxes. Now, the Tax Cuts and Jobs Act doubled the gift tax and estate tax to $10 million through 2025, adjusted for inflation. So that has been increasing every year. The BBBA, the Biden's Build Back Better plan, would return it to the $5 million adjusted for inflation, which is a number that used to be some time ago. So what happens now? Well, if you happen to have a $10, $15, $20 million estate because you're a business owner, you own real estate properties and so forth, and you've done financially well over the years, besides all the taxes that you have paid along those lines for many, many years, now upon death, now you're going to have a gift and estate tax that will be due. So that's a death penalty, as I call it. And that's going to go from the $10 million that was already approved under the TCJA is going to be reduced to $5 million. So that's going to require a lot more planning and a lot more marketing opportunities, especially for people like me that specialize in retirement and tax planning from that perspective. So that's giving me an opportunity to work more with my clients, but is basically telling the clients that unless you start doing something along those lines immediately, then chances are there's going to be an estate tax liability upon your death at some point in time in the future. So why am I telling you all this? Because at the end of the day, you need to be prepared. Now, we don't know what's going to finally happen with this proposed tax plan, but the way I look at it is better to be safe than sorry. So it is important for all of us and all of you to start thinking about your retirement. If you're going to retire in the next 2 to 3 years, you have some challenges along the way, because what you're going to find is that your retirement accounts are not going to be worth a couple of years from now what they're worth today. Not necessarily, although there could be a stock market crash or a stock market correction, and your account value may drop by 10, 15, 20, 30%, perhaps even 50% as it did in 2008. But the challenge for you and for every American is the fact that you have no control over inflation. Now, you could control your personal inflation rate. So, if you're used to doing your grocery shopping at Whole Foods, perhaps you want to go to a local grocery store and reduce that liability, or you may not want to drive as long as you did before and so forth, or you can buy an automobile that is a little bit more efficient when it comes to gas consumption and so forth. But you cannot control overall inflation rates in the United States, and that is pretty much controlled by the government. And that's something that there's not much you can do. What you can do, though, is try to make certain that you can protect yourself and your family from some of the nightmares and some of the confiscation that the U.S. government is doing today to your dollar. Not only the dollars that you're putting away into your retirement account every year, but the dollars that you already have in savings, whether it's a traditional savings account or it's sort of 401k, an IRA, an investment, a piece of property, whatever it may be. Please remember that every time that the government increases taxes, remember the government cannot give you anything back that they don't take from you first. So there's a tremendous amount of confiscation of wealth that is taking place, and the way that these politicians try to paint it is by telling you that they're going to be taxing the wealthy. They're going to be taxing everyone. If you believe that they're going to be taxing the wealthy, then obviously I would encourage you to read a little bit more about economics, because then you're going to immediately change your mind about what that is. And the other thing is, sometimes you hear me talk in my podcast about Republicans and Democrats, but at the end of the day, as I've told you many a times, I am a libertarian. So I really don't give much of a crap about the Republicans or the Democrats. I would argue that, from a business standpoint, which is the only way that I look at these decisions when I do my seminars and my webinars and my speeches, when I talk to many of you through my podcast, is that as far as I'm concerned, there are no Republicans and there are no Democrats. There are puppets and they're puppeteers. And the people that we vote and put into power, all of a sudden, they go in and they think they're going to do a really good job, and the road to hell is paved with a lot of good intentions, but they get involved into the Washington or the local politics, and then they stop being Republicans or Democrats and they become puppeteers. And guess who the puppets are? Well, we are the puppets. So one of the best things that we can do is, if we're going to do anything, I'd rather you be a puppeteer than a puppet. But if you want to avoid being a puppet, then you have to start taking control of your retirement assets. You need to start taking control of your financial decisions, because at the end of the day, it's about you, it's about your family, it's about each dollar that you have in savings, each dollar that you have in your retirement accounts, and whether you're going to be able, once you retire, whether you're going to be able to make it to the promised land or not. And always remember that whether it's a Republican in power or a Democrat in power, they are the puppeteers and we are the puppets. So for those of you that enjoy listening to my podcast, feel free to please reach out to me if you have any questions. You can either call me at area code 786-766-1042, or you can send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you, for your business, and for your family is to kind of help you change the way you see things, because when you change the way that you see things, the things that you see change. So once again, thank you so much for giving me a few minutes of your time today, and I'll talk to you again next week. Take care. Bye-bye.